Okay, welcome to another video. And in this video, as usual, we're going to be going through the weekly macro themes report. This report is the one that we send out to clients, and it covers 5 different topics every week. As you can see here, pretty good example of the range and breadth of topics that we cover. So there's a Fed preview there, correctly picked the passive QT announcement along with many others. Gold in review, a little bit on Bitcoin, which covers some interesting indicators actually. If you want to have a look at that, let me know. Bit on South African equities and Chinese stocks, but today we're going to be looking at gold in review. So first of all, we'll start with the bottom line. The lines in the sand are set for gold on a potential upside breakout and trend change, yet a bearish bias appears well justified. So this is sort of really, the point of this topic is actually reviewing a previous view that I outlined on gold, which was basically a bearish medium-term bias. Now, the charts that sort of set out the tactical or short-term views are these ones here. On the left, you can see the gold price versus implied volatility. You can see implied volatilities come up off the record lows there, and you can see that there's been a tentative breakout from this sort of loosely defined downtrend channel that it's been in for the last about 6 or 7 years. And really this is what's defining the short-term outlook. And while I have a bearish bias over the medium term, and I'll get into that in a minute, you've still got to listen to price, and if a clear breakout takes place, then you sort of have to, in many respects, go with that. Trend changes happen oftentimes in price before they do in fundamentals, but we'll be looking at those fundamentals. But briefly before we do that, I just thought I'd show you what these charts are looking like with the latest data. So you can see here that sort of tentative breakout is still very much in the tentative zone. We can see that it's pulled back a bit, and it could easily come back in below that trend channel, back into that trend channel. But were it to surge out again from here, then that would start to make you think again quite carefully about the outlook there. And also just briefly onto the futures positioning, it's at, I would say, it's basically stretched at that levels to the long side. So that we did see a little bit of a pullback. It's not surprising when you have net speculative futures positioning, which is standardized by open interest here. At these sort of stretch levels, if you consider the recent history here. So I would say that the short-term action based on those two charts, we could see that move go a little further. Which brings us into the fundamental case. So why would I be saying a bearish medium-term bias? Well, pretty much this one here on the left is a key driver of the view. That light blue line is the Krippner shadow Fed funds rate. That's the US Federal Reserve's benchmark interest rate adjusted for the impact of quantitative easing. Now, given that we're entering into quantitative tightening and we're probably going to see another rate hike in December, that line, and it is inverted, so it's going to keep on going down towards that 2% level, is only going to continue to present further headwinds to gold. And if you think of gold as one of the assets that benefits from quantitative easing, money printing, then it stands to reason that when the Fed is tightening monetary policy, underwinding quantitative easing, that will act as a headwind. So, gravity is going to exert itself probably at some point on this. And then the chart on the right is really just highlighting the influence of real yields on the gold price. The reason why, as a bit of a reminder, the theory and the practice there really is that the higher the real yield is, the greater the opportunity cost of holding gold is, because gold has, obviously no yield. So that chart there on the right becomes kind of important then when you look at this one on the left here. Now, a couple of things about this one. First of all, it's a long-term view of US real yields. As you can see there, we are well below the long-term average. My view is that we see a reversion to that mean over the sort of medium to long term, and I've projected it forward here based on forecasts from IMF data, and that's just so what this is the 10-year government bond yield minus inflation, and I've just used their some of their forecasts to put it into some of my other models to project what's going to happen, what may happen there. And so, if you think that the gold price is tied to real yields, and that you expect real yields to rise over the medium long term, that tends to give you a bearish bias. And then the last chart, just to round it out, is real gold price. So it's the gold price deflated by US Consumer Price Index. And you can see there that it's trading well beyond its long-term average. Not as bad as the peak of the bubble, but still, I mean, you could kind of call this a really loose proxy for valuation, and just as when stocks are overvalued versus history, you tend to have it tends to sort of temper any optimism that you might have, if not create a bit of bearishness. So that is pretty much the basis of my view of the sort of bearish medium to long-term view on gold. What would put risks to that view would be, if the US economy rolled over and the Fed had to go and cut rates, do more quantitative easing and end up putting that blue line back up. That would be one thing that would, be supportive for the gold price. And there's still a certain element of safe haven bid. There's the prospects of something happening with North Korea, and there's a few other hotspots around the world. So, there's potential that some geopolitical issue could give it a bit of a lift, but that's not a guarantee either. So I will leave it there. And in summary, the line in the sand that I referred to is this one here. If that breakout up does end up being a bit more substantial and certain, then that could be the start of a trend change. And I still think that the fundamental case stacks up, but prices can deviate from fundamentals, number one, and prices can change before the fundamentals change. So I would leave it at that point now, and if you've got any questions, comments, please do go ahead and leave them in the comment section below. And if you like this video, you probably want to subscribe to the channel, because I'm doing this basically once a week.